It's 2026, and if you're unsure about stocks, ETFs, or crypto, this video will help you think clearly. Cheers to 2026, our year of building financial wealth. Welcome to the Gen Z Financial Podcast. Call me Akosua Biama, your financial consultant. I'm Basiwa, your stockbroker. Today's episode is about a question many people are quietly asking themselves. How do I make better money decisions as we move into 2026? For many people, investing sounds complex or out of reach. Words like stocks and ETFs can feel intimidating, especially if you're just starting out. But the reality is that investing is no longer optional for people who want long-term financial stability. The cost of living is rising, and relying on income alone is becoming increasingly risky. Quick question. If I gave you $1,000 right now and told you that whatever you do with it in 2026 will determine how comfortable your life is in the next 5 years, what would you do? Would you save it, invest it, or spend it and promise yourself you'll start again next year? Because the truth is, 2026 will reward very different investments than 2025 did. And some of the things people are rushing into now might disappoint us. People say investing is risky, but is it really investing that's risky or ignorance? Some people invested in 2020 and changed their lives. Others invested and lost everything. Why? As you're listening, ask yourself, am I investing because I understand it or because everyone is talking about it? Rather than thinking about investing as chasing individual opportunities, it's helpful to think in terms of building a portfolio. A portfolio is simply how you organize your investments based on purpose and behavior, not just what is popular at the moment. For this conversation, we'll talk about 3 portfolio areas that tend to remain relevant over time. The first portfolio area focuses on what the world cannot function without. This includes energy, infrastructure, and core systems that support everyday life. Regardless of economic conditions, demand for these services tends to persist. As a result, investments linked to this area are often associated with resilience rather than rapid growth. The second portfolio area looks at what saves people time or money. This is where technology, automation, and digital services play a role. When people and organizations focus on working more efficiently, solutions that save time or reduce costs usually continue to matter in the long term. This area is often associated with innovation, but its real strength lies in practical application. The third portfolio area relates to what grows with population and lifestyle changes. This includes healthcare, food systems, and housing-related opportunities. Growth in these areas is usually shaped by long-term structural changes, not short-term cycles. When considering any investment, whether a stock or an ETF, a useful question to ask is, which part of my portfolio does this belong to? That question helps keep decisions structured, intentional, and aligned with long-term goals. When you buy a stock, you are buying a small ownership stake in a company. That means you are not lending money, you are not gambling. You are becoming a part owner even if the share is very small. If the company performs well, the value of your stock can increase, makes profit, you may receive dividends depending on the company. Growth that performs poorly, the value of your stock can decline. Buying a stock is saying, I believe this company will grow over time, and I want to grow with it. An ETF, exchange-traded fund, is a collection of many investments bundled together and sold as one product. Instead of buying one company, you are buying a group of companies at the same time. For example, one ETF may contain 50, 100, or even 500 companies. Your money is automatically spread across all of them. Buying an ETF is saying, I don't want to rely on just one company. I want broader exposure.
I don't want to rely on just one company.
When people ask whether they should choose stocks or ETFs, the most important thing to understand is that there isn't a single correct answer. The better question is, which option aligns with your current situation, goals, and level of experience?
Stocks may be suitable if you are willing to spend time understanding individual companies. This includes looking at how a company makes money, how stable it is, and whether you believe it can grow over time. Stocks also tend to suit people who can tolerate price fluctuations without reacting emotionally. If you are comfortable with short-term movements and focused on long-term growth, stocks can play a role in your portfolio. ETFs are often more suitable for those who want a simpler and more diversified approach. They allow you to invest across many companies at once, which can help reduce risk. ETFs also tend to appeal to people who are new to investing or who prefer a more hands-off strategy. If your priority is consistency and lower risk rather than maximizing returns from a single company, ETFs can be a strong option. At this point, it's impossible to talk about investing without mentioning cryptocurrency. For some people, crypto represents opportunity. For others, it represents risk and uncertainty. Cryptocurrency is a digital asset that operates independently of traditional banking systems. Its value is largely driven by adoption, technology, market sentiment, and regulation. Crypto tends to be more volatile and less predictable. Crypto should be approached with curiosity, caution, and clear limits. As 2026 unfolds, crypto remains an evolving space. As with any investment, understanding the risks matters more than chasing returns.
So at this point, which option would you choose? Stocks, ETFs, or crypto?
If you found today's episode helpful, please like, comment, and subscribe. Your engagement helps us reach more people who are looking to make better decisions with their finances. And if you haven't already, we encourage you to watch our previous episode on the money decision you need for your 2026. Thank you for listening, and we look forward to continuing the conversation.